So how much does your property qualify for a HELOC? That's what we're going to run through today. Because it's not only you, but it's also your property. What does it qualify? What's the maximum? How do they calculate it? All these things, they're simple, they're easy, and everyone can do it. So it's a great question we get, and it all comes down to lendable equity in your property. So each property and borrower are going to be unique. We're all looking for the lendable equity in that property when we're looking at either HELOCs or even home equity loans. So the majority of HELOCs now are going to be what they call second mortgages. Typically, everyone has a mortgage on their property already. So let's call that the first mortgage because that's the terms they use in the real estate industry. So a HELOC is typically a second mortgage. So you're going to keep your first and it's going to be a second mortgage on your property. Typically what they say in second position because your first mortgage, the mortgage you already have, is there and you're going to put one right behind it. But how much do you qualify for on the property you have now? It all comes down to what they call CLTV. So what is CLTV? CLTV is what they call the combined loan to value. That is what lenders look at for the lendable equity in your property. So combined loan to value, what that is it's calculating the maximum amount that they will loan based on the combination of what you already have and what you're looking for. So we're going to go through an example just to show you exactly what your lendable equity is. So if you have the information, you should grab it. How much your property is worth, go out to Zillow or Redfin or any of those other companies out there that provide that information, or if you just know what the market is going for, and what you currently owe on your mortgage. So those are the two things that you're going to need to figure out exactly what the maximum loan you could get on a HELOC. But also remember, on HELOCs, what your maximum loan is does not mean you have to take that out. You could take out a portion of that or all of that and just have it available. So let's look at an example of figuring out what the CLTV is, the combined loan to value on a property using the example. So depending on the market, what you qualify for, where you're shopping for that HELOC, you're going to find typically that the combined loan to value maximum is somewhere between 80 and 90% of your current value of your property. Let's say a credit union will give you up to 85% combined loan to value on your property. Your property in this example, let's just say is $400,000. So what they do is they take the $400,000 value, times it by their maximum lendable equity, which is 85%. So we take 400,000 times it by 85% or 0.85, and we get $340,000 of lendable equity. So now what do the lenders do? Well, they take that $340,000 because that's the maximum combined loan to value. And we already know you have a first mortgage or a regular mortgage on your property. So they're going to subtract that dollar amount from the lendable equity. In this case, we have $340,000 we calculated as lendable equity, and we know our mortgage currently is $280,000. So they're going to subtract those two, and they're going to come up with a maximum lendable equity on a HELOC or even a home equity loan of $60,000. So that's the maximum you could take out on your loan is the 60 grand, but you may only want to take out 30. That's fine. You don't have to take out the maximum. You can take out up to the maximum. So you may only want to take out 10, 20, 30. Just make sure that you take out what you need to give you the comfort level to get where you want to go. If it's home improvements, if it's cash out consolidation, whatever it is. Now that's based on 85% in the example that we use, but it could be somewhere between 80 and 90% depending on the market, depending on where you qualify. So make sure you reach out, find the credit unions, the local, typically it's smaller or mid-level banks in your area that are going to give you the best HELOC options and rates. So shop around, look around, because you want to make sure you're getting the best deal, not only on the loan to value, but on pricing. Also remember on HELOCs, you're only paying for the amount that's outstanding. So even at closing, you don't have to take out anything. You could go get a HELOC just for protection in case you need money as a reserve, whatever it may be. Just remember, whatever the property can qualify for, doesn't mean you have to take it. Doesn't mean you have to take it all out then or anytime in the future. So it all comes down to how much lendable equity you have based on your current valuation, based on the current mortgage you have out on the property right now. The difference between the lendable equity and what you have is the maximum you could get on a HELOC. Now, if you want to know what pricing is, we have a great download on smartwithdebt.com. It is a shopping guide for HELOCs. You can put in the different rates and quotes that the credit unions, the banks are giving you. You could find the best deal on rates. But this is all about loan to value, a combined loan to value. If you're looking to maximize it, you're going to find or going to look for those institutions that are giving you a higher combined loan to value, or at least allowing you to go up to that loan to value. Typically, we see 99 out of 100 people who are looking to do some consolidation. They do better when they're looking for a HELOC or even just a home equity loan over, a cash out refinance, because they're cheaper. They're cheaper, short term and long term. You're going to pay less over time. Not only that, but you could max out. You could actually get more money out of your home by using a HELOC or a home equity loan than you can run a cash out refinance. Somewhere typically between 5 and 10% more on one of these products over a cash out refinance. You're not going to pay all the big fees. You're not going to stretch everything back out to 30 years. And more than likely, your current mortgage is at a really good rate, maybe, 3 or 4%. And now you might double that. Don't do that. Look at something like this and just reach out to your local credit unions. Check out our shopping guide on smartwithdebt.com. Our goal here is to make sure you're getting in the best debt, good, healthy debt, that you're paying the least amount to the lenders and keeping more in your life.